Well, hello. Welcome to my studio here in fabulous Las Vegas. This is Dean Tenney. I've been explicating the FINRA content outline. And, sometimes when I'm doing the explications of the student outlines or content outlines, I watch them back and I think, well, I probably could have done perhaps a better job on that and miss some things. And when I miss something, it's a little thing, I put it in the comment box and address it that way. So always make sure you look at the video description of the comment box, description box, because there is testable content there. In this case, I looked it over and listened to it, and I thought, you know what, I got to add some more stuff to it. So that's what I'm going to do. This is a replacement of the original explication. So you already have you can see my comments there in different colors. I'll go through that, but I also want to add some other stuff. So that's what we're going to do in today's this morning's explication. This explication is due to premiere at 1 o'clock today. And so there's a little sense of urgency because I still want to have it premiered. We got somebody testing Monday who finds these very helpful. I want to do that. All right. So we're on packaged products, not what Dean calls packaged products, what FINRA calls packaged products in critical function 3, which is 91 questions, which makes sense that providing basic product information about investment vehicles to customers is the biggest part of your Series 7 top-up. So no surprise there. And one thing you got to be able to do on your test is contrast an investment company, that's, the fancy word for mutual fund, with ETFs and unit investment trusts. And so the contrasting points that you get tested on is that exchange traded funds trade in the secondary market, supply and demand. There is no forward pricing in an ETF. Reg T says I can't extend credit on new issues. It's considered a new issue 30 days from the effective date, and all open-end funds are continually issuing new shares to the public. And so one of the things that ETFs you can do is you can buy them on margin, you can borrow against them as collateral, and you can short them. So that's another distinction between an ETF and an open-end mutual fund. For test purposes, they're not actively managed, and that means they have a lower cost structure. And it also means they're more tax efficient because there's not a manager who's buying and selling securities. So those are the contrasting points on an ETF versus a mutual fund, and that's very, very testable. I haven't had a debrief anybody tell me they've seen anything about a unit investment trust in a long time, but in a unit investment trust, the assets are professionally selected, but they're passively managed. So, you're buying this trust. Usually it's like muni bonds, for example. We professionally select some municipal bonds. We put them in the UIT. Nuveen is huge in this, this category. And you say, hey, Dean, is there going to be anybody buying or selling the bonds? I go, no, they were professionally selected, but the interest will be passed through to you. And when the bonds are redeemed, that'll be passed through as well. We have various types of mutual funds. We have equity mutual funds, fixed income mutual funds, and we have money market funds. And you're going to get tormented on money market securities, high quality debt maturing in less than a year, like commercial paper, like bankers' acceptances, negotiable jumbo CDs, like T-bills. And just recently, I had some really great debrief that they got a test question about the difference between a retail money market fund and an institutional money market fund. And the major difference that I would think that test question is about is that retail funds keep the NAV at $1. It doesn't float. Whereas in institutional money market funds, the NAV can float from the buck. It can float above or below. You're definitely going to get 2-3 questions on the difference between open-end and closed-end funds. And I guess it's good that I get to come back and redo this because I can make some corrections of typos. So open-end funds, we said, are continually issuing new shares to the public. And that is not true of a closed-end fund. A closed-end fund does a one-time initial public offering, and then it trades supply and demand. We're trying to match the fund's objective with that of my customer. And so we have, value stocks, therefore we have value funds. We have growth stocks, and therefore we have growth funds. We have income stocks, therefore we have income funds. We have a balance fund, balance between equity and debt. We have international sector, life cycles, all the ones that, you would expect. All right, so characteristics. Open-end. We're always doing business based on the next calculation of the NAV, and that has to be done at least once per business day. So NAV is done once per business day. We're always doing business based on the next calculation. The NAV plus the sales charge equals the public offering price. So I just put an example here of a mutual fund that has a $9.15 NAV, an 85-cent sales charge, and therefore the public offering price is $10. In terms of expenses, let me get out my annotation tool here. In terms of expenses, the largest single expense to the mutual fund is the investment advisor, right? So, they say the largest single expense to mutual fund is, and you say the investment advisor. Now, be careful when you're being asked. The largest expense to my customer is the load. 12B1 fees are promotional expenses paid for marketing. The fund pays it, not the investor. And what the test has is worried about is misuse of no load terminology. So whether I sell you an A share where there's a front end load or a B or C share where there's a contingent deferred sales charge, I'm not supposed to make you think it sound like there's some free lunch. So misuse of no load terminology. Now, Vanguard is truly a no load fund. If you give Vanguard $100,000, $100,000 goes into the fund. Now, if Vanguard chose to, they could charge 25 basis points. If you want to sound like a player, 25 bips, 0.25%, and still refer to themselves as a no load fund. You go past that, you can't refer to the fund as a no load fund. If a promotional expense in no circumstance can that be more than 75 basis points. Whoop. Yeah, well, obviously Dean is as good at using these arrows as I am using my pen. Right? In no circumstance can you go past that. Closed-end funds, as we said, trade in the secondary market. That's very testable. Very testable. Sales practices. One thing that we need to know here, let me get a different color, is that breakpoints, let me get a different color, are a good thing. A breakpoint is a quantity discount. And that is good. And a breakpoint sale, that is bad. A breakpoint is a quantity discount. A breakpoint sale is when you avoid the breakpoint to maximize your sales commission. That's a big no-no. Learn that once, get tested twice. The state administrator frowns on that as well. Now, the easiest way to stay out of trouble with a breakpoint sale is tell somebody all the different ways they can get that reduced sales charge. And, one way they can get the reduced sales charge is we can say, hey, can you fill out a letter of intent, an LOI, which is good for 13 months, very testable. Can be backdated 90 days. There's no way the customer can get hurt by filling out that breakpoint, or that letter of intent. The persons who don't get breakpoints are investment clubs. So let's just put that, no breakpoints. We don't allow investment clubs to pull their purchases for meeting the breakpoint. So here it says computing sales charge. I'm going to show that to you in a minute. I'm going to show you dollar cost averaging, but I've now talked to you about breakpoints. Breakpoint, remember, is good. Quantity discount. Breakpoint sale is bad. That's a violation of what we call the code of conduct. The best way to stay out of trouble is tell you all the ways you can do to reduce sales charge. I say, listen, if you sign a letter of intent, tell the mutual fund you plan on coming up with this money within the next 13 months. They'll waive the higher sales charge, let you in at that discounted sales charge. And that means you'll buy additional fund shares. Those will be escrowed. If you don't fulfill it, we'll back flag the account. No way the customer can be hurt by signing that letter of intent. Dollar cost averaging, very testable. What makes it work? Fixed dollars invested regularly. Number two, what you end up with? A lower average cost than those of the underlying shares, and it doesn't guarantee a profit. I would be prepared on your exam to actually have to do an example of that where they say somebody's giving you like $100 a quarter or they're doing something, like that. Calculating the sales charge. So again, we're just explicating that, computing sales charges. And here's how you compute the sales charge. We said one way you compute the sales charge is just to know that NAV plus sales charge equals the public offering price. But you might have to figure out the percentage sales charge. And the way you do that is you take the sales charge. In my previous example, it was 85 cents, and you tell me 8.5%. 8.5%, by the way, is the legal limit, and I would know that as well. Let me get out my annotation tool. That is the maximum sales charge. Here it says you also might have to figure out the public offering price. Let me give you an example of that. Maybe you qualify for a reduced sales charge of 6.5%, with breakpoints. So I just made that up. And we said the NAV in our example we're working at is $9.15. And so what I would do is I would take, as you see here, the NAV, $9.15. And I would divide that. I'm just making up the 9.15. And I would divide that by 100% minus the sales charge, which in my example I'm working with you is 6.5%. And that equals the public offering price. And so we're going to take $9.15 and we're going to divide by 0.935. And let me get my calculator out. And my calculator, $9.15. And if you qualify for the 6.5% sales charge, you're not going to be paying 10. We divide that by 0.935. We take $9.15, divide by 0.935, 93.5%, and we find out you would pay $9.78. And again, that's a much better than the difference there. Just so you can see that's $9.78. Okay, so redemption price, payout withdrawals, it's not magic. Once you start withdrawing, whether you do fixed dollar amount or fixed number of shares, it doesn't matter. You're going to run out of money. You're going to exhaust this thing at some point. You may or may not, but that's the assumption on the test. That's setting up a contrasting point with an annuity where, the annuity, will pay you for the rest of your life. So, anyway, Subchapter M, die 90, very testable. If we didn't have die 90 or Subchapter M, what would happen is the corporation would make money, pay taxes, pay a dividend to the mutual fund would pay taxes, and then the mutual fund would pay you a dividend as a mutual fund shareholder, and you'd pay taxes. My God, the money would get taxed 3 times. The IRS has been kind enough to say that as long as the mutual fund passes through 90% of the net investment income, they will wait and they will get that from the mutual fund shareholders. Now, one of the major disadvantages of a mutual fund is you give up tax control of your investments. So you don't decide when to sell the securities. If I own an individual security, the capital gains tax is a transaction-based tax, and the easiest way not to pay it is not to transact. But I don't get to decide that. If I own 1,000 shares of Google that I bought at the IPO price, that's 85 grand. Now the Google's $2,000 a share. That's $2 million. And if I sell that, I'm going to capital gains tax on $1,915,000. Woo! Google, 10% of it was bought at the IPO price by Fidelity. So Fidelity is still sitting on 10% of Google. And if they sell the Google, there's going to be a huge capital gains distribution to the Fidelity mutual fund shareholders, and they're going to owe taxes on that. So even if I tell Fidelity, listen, I don't need the dividends and capital gains, just buy me additional fund shares, I'm still going to owe taxes on that. Charges and expenses. We talked about the charges. We said the maximum sales charge is, I didn't get my different color here. The maximum sales charge is 8.5%. We said the load is paid by the customer. That's not paid by the fund. So that maximum sales charge is paid by the customer. So be careful whether you're being asked about charges to the customer or, expenses of the fund. Those are entirely different things, right? So we said the max, it's not giving me a different color. No, it's not giving me a different color. Let's try it again one more time. If it doesn't work this time, I will give up. There we go. Is 8.5. And whether that's, 4 or 6 or 8.5, that's paid by the customer. We said the maximum 12B1 fee, and still refer to yourself as a no load fund, is 0.25. And we said, under no circumstance can that be more than 0.75. That would be the max for 12B1 fee. And we said you got to pay for, various other things, the board of directors and all that stuff. And we said the largest single expense to the fund is the investment advisory fee, is the largest expense to the fund. Remember, to the fund, variable annuities. I don't have variable annuities in any of the playlists, any of the lectures that you find on the YouTube channel. And so I want to do a little better job here. The reason there is no lecture, and I haven't put anything, under customer accounts, I talk about a little bit about how a variable annuity works. Is I just don't think it's worth it. There's, I don't know what provider you're using, whether it's Kaplan or, Past Perfect or SDC or Knopman, we're agnostic on the YouTube channel about, what study materials you choose. That being said, they all go completely overkill on variable annuities. So that's why I didn't feel bad not having anything up on the YouTube channel for that. Now we're going to correct that right now, talking about packaged products. I think of a variable annuity as a mutual fund with an insurance wrapper. And we call this a non-qualified retirement plan. Now, the reason we call it a non-qualified retirement plan is because you're using after-tax money. And so, if I go to put, maybe I put into a non-qualified retirement plan, $200,000. So that's my contribution that I'm putting into this variable annuity. And, what I'm going to do is put this money into a separate account, which is a, mutual fund. So that's what I mean by it's a mutual fund with an insurance wrapper. If every time on the test you hear the word variable annuity, you just think mutual fund with insurance wrapper, you're going to be in pretty good shape. You're going to be in pretty good shape. So let's say I put $200,000 into this thing. And, I'm going to pick one of the separate accounts to put this into. And what I'm hoping is whatever separate account, which is a mutual fund, it grows. And I can choose to draw down. At 59.5. So, I put this in here. Let me get my annotation tool again. Let me get a different color. And so I put this $200,000 in there. And now at 59.5, there is $1 million that I have in that variable annuity. And that's been growing tax deferred. So it's kind of like a retirement plan in that I have to wait till 59.5. If I get it out early, I'm going to owe a 10% penalty. That's why we call it a non-qualified plan, because it looks very much like, a retirement plan in that regard. The money is growing tax deferred. What I'm buying are accumulation units. And again, I would think you'd be fine if you thought of accumulation units as shares. What I mean by that is it's again like a mutual fund. To say that you have 6,000 accumulation units in a separate account intellectually is the same thing as saying you have X number of shares. It's just a different language. And so a lot of times when people say, hey, Dean, you told me there were no variable annuity questions. And I said, well, I didn't say that. I said maybe 2 or 3. That being said, it's a lot of times it's just a camouflage mutual fund question. For example, what is the accumulation? How often does the separate account have to calculate the accumulation? And you would say every day, every business day, right? So anything that's true of a mutual fund would be true of the separate account in terms of test taking. So every time I hear separate account, I'm saying mutual fund. Every time I hear accumulation unit, I'm going to say shares. I'm going to be in pretty good shape with that. Every time I hear variable annuity, I'm going to think mutual fund with insurance wrapper. So we're going to have, the performance of the separate account. That's very important because in a fixed annuity, the investment risk is assumed by the insurance company, but a variable annuity, very testable. The investment risk is assumed by the annuitant. I just told you again, foreign. It's like a foreign language. Valuation, a surrender value. And then when you annuitize, we're going to turn your accumulation units. Don't get too hung up on this because, you're not doing this, some actuary is. We're going to turn your accumulation units into annuity units. So that's the transition. If you choose that you're not going to do a random withdrawal, so in our example here, one thing we could do instead of annuitizing is start taking withdrawals. So instead of annuitizing, instead of choosing to turn this into an income stream, we can take a lump sum or we can do a random withdrawal. And, in my example here, we have 200,000, it's now $1 million. And if you say, Dean, send me that $1 million, I say, oh, cool, I'll send it to you if you do a lump sum instead of annuitizing. I say, okay, well, you paid your tax on the 200 grand, so you're going to owe ordinary income tax rates on the $800,000. It's taxed. When you withdraw. You say, well, gee, you didn't tell me that. I said, well, I should have. Right? That's something you should have known, when you first put this money into there, right? We're talking about a variable annuity. We're talking about a variable annuity. Here it says 200,000 million, but you could also do a random withdrawal. And so let's say you do a random withdrawal. And you say, hey, Dean, let me get my annotation tool out here. Let's get us a different color. And you say, hey, Dean, send me, I want a different color to highlight that. You say, let's do a random withdrawal of $200,000. And you say, hey, Dean, that's the 200 grand I already paid taxes on. I say, absolutely not. Very testable. It's last in, first out. Last in, first out. So, you need to know on your exam when you're going to use LIFO or FIFO. And, there's certain things that are FIFO and certain things that are LIFO, and this is LIFO. Last money's in, our first money's out. All right, well, another choice you have besides doing a lump sum withdrawal or random withdrawal from this variable annuity when you're 59 and a half is you can turn it into income stream. By the way, you don't have to annuitize at 59 and a half. You could wait. The longer you wait, the more the money builds up, the bigger your check will be because you're not going to live as long. But let's assume you decide to turn it into a income stream that you can't outlive. Kind of a neat thing to be able to do. And if you do that, life only, if you tell the insurance company you want to be paid for your life and your life only, that would give you the largest monthly check. And that is a test question to know that would give you the largest single check is if you choose life. You could do life with joint survivor. You could do a life period certain, whatever you'd like to do. Now, once you set that in motion, we have what's called an assumed interest rate. And your check is going to go up and down based on the assumed interest rate. Let's see if I put that. Let me see if I put that in here. It doesn't look like I did, so let me get another text box. And, your check, if we get better than the air, the assumed interest rates, you'd be doing yourself a service every time, you get one of these questions. You just spell out whatever the acronym. Better than the assumed interest rate, the check goes up. We're not going to take it up or down by a lot because, the idea here is you're in retirement and we don't want to cause your check to go all over the place. And if we get the same as the assumed interest rate, check remains the same. The customer is the one who sets this in motion, right? And if we get less than the air, the check goes down by the value of one annuity unit. So it's not going to be bouncing all over the place, 20, 30 bucks, whatever the annuity unit is, check goes down. Now, remember, of that check, some of that represents, remember, your own money coming back to you. So if we set this in motion on this $1 million, we're going to have 20% is going to be the exclusion ratio because 20% of that money, remember, you've already paid taxes on. So, how do I get that? That's 200,000 of that $1 million. And I haven't anybody tell me they see any test questions on that, but you do taxes on 80% of whatever that check is, Okay, we're talking about package products. Tax treatment of variable annuities during the accumulation period, it's growing tax deferred. We talked about that during that period. The annuity period, we talked about what happens if you annuitize. And then we talked about taxation if you get it out early, right? You surrender this thing before you're 59 and a half. We're talking package products. REITs, real estate investment trust, is a package product. You buy it for the same reason you buy a mutual fund: professional management, ease of ownership, and diversification. However, you're diversified in a portfolio of real estate. And so how do you make money in real estate? You make money in a real estate through either equity, mortgages, or a little bit of both. And then it too, test question, passes through 90% of its net investment income. That too is a test question. Right now, please note, mutual funds and REITs don't pass through losses, just their income. The only thing we have that passes through both income and losses is direct participation programs, also known as partnerships. And so, the limited partners provide the money. The general partner provides the experiences, manages the business day to day. Limited liability companies also have a pass through, and Subchapter S's corporations have tax through. So what we're saying is that LLCs and Subchapter S's work very much like partnerships. Now, you can't get into a partnership or out of a partnership. You can't be admitted to a partnership or EMIT without permission of the general partner. That's very testable. That means you do not have a freely transferable interest, and that means test question. They're clearly unsuitable for anybody who needs their investments to be liquid. Both the profits and losses flow through, as you see here. And so that's going to be cool that it flows through. I usually use the Golden State Warriors. That's a partnership. The Warriors don't have any tax consequences. Whatever happens to the Warriors, the Golden State Warriors, the partnership gets passed through to those Warrior partners. They're going to get a K1 that tells them whether it's a profit or a loss. Now, remember, whatever that is, it stays in that category of there. I'll refer to you to a taxation lecture where I go over that at length. Tax treatment, oil and gas tax advantages. So, depreciation is a non-cash expense, and that's a nifty thing because, cash flow is different than depreciation. So check out the partnership lecture. It's about an hour, and I go over how that works in terms of your K1 and what the flow through would be to you. Oil and gas also has a depletion allowance. They reflect the fact that we don't know how much oil is down there, but we do know that we pump a barrel and sell it. We've got one barrel less, and that's to give us an incentive to go, find another barrel. We also have intangible drilling costs as another tax advantage. We get to deduct what it takes us to prepare to actually drill the hole. We have types of direct participation programs that are organized to buy real estate. We have partnerships, direct participations where we buy oil and gas. We form partnerships to, do small cap debt and equity. We form partnerships to do business development corporations, equipment leasing, and then we have advantages and disadvantages and tax risk and implications to all of these. And again, I would refer you to that lecture. I would definitely know that exploratory are the riskiest. And then how do we offer them as brokers, Series 7s? How do we offer them? We either offer them as a private placement using Reg D and giving a private placement memorandum to the appropriate accredited investors, or we can sell them retail, so we can sell them either way. How do we evaluate a partnership as a potential investment? We look at the expertise of the general partner. Joe Lacob is the general partner of the Golden State Warriors, and he was formerly a general partner of a venture capital fund. I'm not sure if that's style drift or not, but that's something you'd want to know. Is this the first time they've done oil and gas? And have they operated, in that space for a long time? What are the objectives? What is the leverage? All those things go into it. On your exam, 5 partnership questions. We already explicated options. Now we're out of packaged products, but I'm going to put hedge funds into this same explication because it doesn't support itself as a standalone lecture. And so I'm going to go ahead and explicate hedge funds in this discussion that I'm having here, because, how Dean thinks of it and how FINRA puts it in the content outline are different things. And so I want to put this in there. The reason I think it fits is because the whole point of a hedge fund is to avoid the Investment Company Act of 1940, right? You don't want to have anything to do with that. And remember, an open-ended mutual fund has to comply with both the Securities Act of 33, because they're continually offering new shares. And so open-end companies are going to give you a prospectus. And, in a hedge fund, we want no part of that. And so, hedge funds are organized in funds of funds that invest in hedge funds as private partnerships. And the general partner is typically the hedge fund manager, and the limited partners are investors. As I said, since we're using the private format, we're not going to have prospectuses because we're not going to be using 33 as an open-end mutual fund is, right? And we're going to avoid the Investment Company Act of 1940, which is the whole point. So, typically the structure is a private placement. The investment advisor to the hedge fund is going to register with the SEC as an investment advisor typically, but not the fund itself. And the whole point we said of this is to avoid the Investment Company Act of 1940. By the way, this would be no different if it was instead of a hedge fund, it was a private equity fund or a venture capital fund. They're all organized this way. Characteristics, limited or no liquidity, right? Because we said you can't get in or out of the hedge fund or the venture capital fund or the private equity fund without permission of the general partner. They have very limited information. Unlike a mutual fund that reports semi-annually, some hedge funds, some venture capital funds, private equity funds have annual partners meetings, but they're not required to. They typically say you're going to be locked up. You're not going to be able to get your money. I know some hedge funds where there's a $50 million investment with a 5-year lockup. A 5-year lockup means don't even ask for your money back for 5 years. And even when you do so, the hedge fund might say, hey, the gate is not open. Gate not open means you ain't getting your money. Charge and expenses are large. It's typically 2 and 20, as you see here. 2% of the assets under management, 20% of the profits. And they're allowed to do all kinds of different things that mutual funds can't, like options and commodities and, swaps and all kinds of stuff, right? The guy who bought the New York Mets is a guy named Steve Cohen. He's a hedge fund manager. He's 3 and 30. Oh my goodness. 3% of the assets under management and 20% of the profits. Okay, well, just to remind where we're at, where we're going. I'm going to put this up a little quicker than we have. I've got into trouble on the YouTube channel trying to pace my lectures with people's test dates because that's not a sustainable practice on my end. But, I can't help myself if I have somebody who's loyal to our channel, and, they like and they subscribe and they comment. And then they tell me they're testing Monday like this person is. I'm shout out to him because that's the only reason this is going up today, Sunday. It's because he's testing tomorrow. I will try and, do what I can. And he's found these things pretty helpful in his study effort. And so, we've got 2 or 3 of these explications that are ahead of the publishing schedule for him. But just want to remind you where we're at. We're working our way through explicating the Series 7 content outline of FINRA. You can find this in the playlist under FINRA outline content outline explication. I'm not putting all of these in the lectures where they fit. Sometimes I do, but sometimes I don't. But if you want the complete explication, critical function 1, baby broker finds customers. Critical function 2, baby broker opens new account. Again, term of endearment. Critical function 3, it's a chronological, by the way, from the test writing committee. Baby broker knows investments. Now that comes from taking your test, right? And, practical application, but it makes sense that that's the biggest thing. The biggest critical function is providing basic product information to customers. We're not through critical function 3. We still have to do equities, corporate bonds, government securities, CMOs. We certainly have lectures on those, but we haven't finished the explication of those. We'll get it done. We'll get it done at some point, but we'll see if he makes his mark Monday. I think he will. And then we'll go back to our normal pace of publishing lectures. We got to finish the explication on the 7. We got to finish the Series 7 math and calculations lecture. I want to explicate that. So make sure you subscribe because it'll show you where the premiere is. And when these premiere, this is premiering 1 o'clock today, my time in Las Vegas. And I run a chat alongside that. And that's a good place on that live Q&A chat. You don't have to be a Series 7 person. You can be a 63, 65, 66, SIE. You can ask any question about the actual premiere that we're watching, which is in this case, critical function 3, mutual funds, variable annuities, and hedge funds, and ETFs. But you can also ask questions about other things. Okay, I'll see you at 1 o'clock Sunday. If I don't see you there, I hope you've enjoyed this explication. Share, subscribe, put in your suggestions for any future lectures.